Alright, well, that wasn't the close I fucking wanted. That sucks. Eh, not terrible. What's up, guys? We're gonna go over end of day here. Getting a bit of a downtrend going. Alright, so we closed to the lower end of the implied move today. Still below gamma neutral and delta neutral on the weekly. Both gamma neutrals and delta neutral on the weekly. Did get a bounce off of the 6840 level, which is roughly about the low of the day, right before Vana flipped. So we didn't get the big vol spike, but we did get an uptick in vol. I mean, VIX up 3%, VIX 3-month up 1.33, VX 2%. Overall, I mean, this is a continued pattern of distribution. Obviously, there's a gap down here, like this 67.90 level, but I'd be more focused on like 67.89, which is now opened up. Obviously, on the technical side of things, we have lost the trend. Uh, Here on ES, the trend's a little broader since the bigger trend failure, but this is still distributive price action, right? Lower highs, lower lows. So 68.43 and 68.12 still open to the downside. Things flip more bullish if we can get back above 69.65 at last week's close. And today's bounce off the low was a little bit stronger than yesterday. We'll see how that performs in the overnight session. I know Google had earnings today. Looks like they're up a little bit in post, but not very much. I know CapEx was a big shock there. So, like revenue performance and stuff looked pretty good, but CapEx was about 3 times what was expected. Um, I think Oracle did very poorly on their earnings. Um, dollar crept back up today. A lot of this on the yen losing ground due to the upcoming parliamentary elections. If the current incumbent, I forget her name, wins, she's expected to proceed with a policy of loose monetary policy and a lot of fiscal stimulus, which has kept the yen worthless for the last 30 years. So that Abenomic approach, not great. At least not great for the strength of the yen. Really rough for their inflation. Remember, because their currency is devalued and they're an import-based economy. Well, import-based country. I mean, they have to get all of their energy imported, and many of their products imported. Having a weak global currency is not great for them. Um, Yields continued up at the top end. That's been pretty consistent since about mid-November, where we've seen the 10-year, the 20-year, and the 30-year all rising fairly consistently. That started to accelerate with declines in the dollar, but some stabilization after Dixie hit its most recent low has kind of normalized things a bit. I guess if we're talking dollar, inverse dollar, BTC down 4.25% today. This is falling to levels where people who were buying into the BTC ETFs when they opened up are now substantially underwater, like more than 25% underwater on any positions they're continuing to hold, which is probably accelerating the downside there. I mean, I'm pretty sure that MicroStrategy is probably facing some form of liquidation soon, and they're also, very, very underwater on their positions as well. Uh, the peak in the peak that we got here in broad commodities, kind of completing a little bit of a cup there. A pullback to 108 would actually set up the cup and handle from the last big commodities push in 2022, and open up, much more extended upside move. But that would probably still require some dollar debasement, and so far we're not seeing that happen yet. Correlation continues to break down after hitting lows around, well, 1 month correlation around 7 last week. Some of that breakdown in correlation turning around today. We're getting a bit of instability in that, but volatility is continuing to rise on the indexes through this period. And it doesn't seem that the stabilization from corporate buybacks is really helping much, with big tech capex up so high. I would imagine that they have slowed the pace of their buybacks pretty substantially. Still no move in bond volatility, but 3-month correlations picking up. Carry trade keeps kind of shifting up and flattening out, back at 10.23x, so still substantially over leveraged, and the forward yield on volatility is getting very close to turning positive. This is XAU USD versus the PNL and the carry, and we're seeing that kind of move a little negative with the risk profile there for golds, or at least how it's weighted relative to the carry. The cumulative cost of carry at negative 18.663%, but today carry trade was a little bit profitable. However, I would imagine silver tells a bit of a different story, and it's kind of hard to tell. But if gold continues to slip and that turns more negative, we'll probably see gold decline. I can check XAG USD real quick. We can see how silver looks against that backdrop as well. Yeah, so silver also starting to move a little bit negative. Obviously not impacting the cumulative cost of carry nearly as much, but that also looks a little bit bearish as well. As the profit rises on the carry trade, the tend to see selling in precious metals, which might have to do with international central bank exposure to gold and silver relative to the dollar more than anything. But skew down. Looks like 20-day movers are kind of starting to stabilize a little bit over the last couple of days with this move to the downside. We are starting to see a little bit drag in stocks over their 200-day moving average, but not much. So the breadth in this sell-off is a bit lopsided, but so far it does look like it's somewhat continuing. Fed fund futures, there's no cuts expected. The 10-2 up pretty substantially. I think this is a new local high. We're very close to one. Yeah, this might be a new local high for the 10-2 spread at 72.3%. So for IORB, well, that's the wrong fucking one, so we can get rid of that shit. 10-2, oh, VIX correlation, still put sellers coming in. So, obviously our low of the day met a fairly significant amount of put selling. We did sell back off into close, so those put sellers are likely at risk. But the peak of volatility today did get stomped down pretty hard. Correlation falling from 81.95 down to 80.86. And correlation's still fairly high, but there are put sellers stepping in, probably on the 30-day contract more than anything, where the VRP, or the spread between IV HV is a bit more positive. SOFR started to flatten out today. This could be a warning sign for upside, and might mean a reversal back. We held the spread now 2 days in a row of 4 points. So 4 points between the interest rate on reserve balances and the secured overnight financing rate. This obviously makes, people want to sell equities for short-term cash, basically, or bonds, either one, but short-term cash financing is not cheap or as cheap as it should be. Now, if this normalizes, this kind of happens at the beginning of every month. It's been more extreme in prior months before the Fed started doing buybacks. This month's a little bit more calm, but once this normalizes, the market tends to run once that short-term cash liquidity picks back up again. So we'll have to see if it does, but it flattening out today, I think, is maybe not a great look, and so we might start to see that turn back around until we get to Feb OPEX, where cash demand picks up again. And then lastly, leverage. Is that the right one? That's the right one. Nope. I want that on its own scale. Piece of shit. Okay, hold on. New price scale. There we go. Let's change that to red. All right, cool. So leverage falling with the downside move. Peak of leverage on this move up was pretty substantially lower, and they've been getting lower since November. So the peak of leverage back in like December, also lower. Peak of leverage here, lower. This is kind of a risk-off trend. I mean, the last time we saw that really significantly was beginning of back in Jan of 2025. We saw the market pretty much continuously risk off all the way through, well, even past the low in the market in April. But we are starting to get down right around the range where the index failed back in Feb of 2025 as far as leverage goes. We bounced off that level a couple of times. But falling through that could mean more substantial sell-offs. And then, obviously leverage much lower back in like 2022, the last time we had any kind of real bear market. So, it's a good thing to keep an eye on, the BTIC adjusted interest rate on S&P's total return. This gives you a pretty good idea of like EFFR or futures leverage relative to price action on the SPX or on the index itself. It's a good chart to watch. Sell volume, not as high as yesterday, but decent. Sector wise, I mean, most of the sell off today in tech, obviously, health technology massively overperforming due to Lilly and Amgen. Some of their earnings reported today. Producer manufacturers selling off a little bit, probably with the ISM report. AMAT, LRCX, GE, and CAT all pulling back a little after dizzying runs since the start of this year. And then just almost all of tech not doing well. Services prices were sky high on the ISM report today, and that's a proxy, generally speaking, for CPI inflation. And so, I mean, it would indicate that inflation is likely much, much hotter than what's being reported, which is not great for everybody seeking to pack on a ton of debt. Financial sector doing pretty well today, though. We're getting a bit of rotation: consumer non-durables, energy, mineral, transportation, process, consumer services, communications up. That's always a little bit of a bearish sign, and energy minerals rising with the escalation of potential conflict in Iran. And then lastly, we slipped below the trend, bounced off eventually, back above the 68.82 level, which is somewhat important. That means we did close above the 50 MA despite slipping it today, but we did close very close to it. The 20 MA and 30 EMA are now trending down, which is, a bit of a shift overall, and tends to follow into more bearish price action, but we still want to see that trend lost. And the next important, fairly significant level to the downside at 67.8905. I would say that holding this is somewhat bullish, and we may get a bounce maybe back to like 69.20 or 69.45 before getting another leg down. But if the data into the end of this week isn't too great, then we might actually just get that leg down tomorrow. As this like continues to kind of push up against its failure point. Beyond 67.89, I would say like 65.21 back at like November's lows would be the next really important downside target, and a failure of this rising wedge that we've been stuck in since November. And I think that's about it. So thank you guys. And I'll see you tomorrow morning. Later.